Hey everybody, welcome. It is, can you believe it's April already? April 3rd, 2023. Welcome to, did I say 2023? 2025. Wow, this year has gone by fast. It is really true, the older you get, the faster time seems to go, even though time is, of course, the same, no matter how young or old you are. Anyway, I hope you can hear me okay. I had the second camera set up outside, but it looks to be doing some weird things. It looks like one of those old school webcams that took a little snapshot every second and then uploaded it. It's not supposed to look like that, but that is the view from the Financial Think Towers here. And it is hot in Orlando, Florida today. 31 degrees Celsius. Thankfully, it will get a little bit cooler towards the end of the week, but I always get asked the question, when is a good time to visit Orlando to come to the theme parks? And I got to tell you, we've had an absolutely amazing winter this year. And I think the best time to come is April. No, March. Early to mid-March, I think you tend to have the best weather. You get a little bit of the cooler winter. You don't get the blazing heat. And I know a lot of people can't do it because the kids' holidays are not during that time. But if you ever want to come at a good time, that's about the safest weather bet you can get, where it's just going to be sunny. It's going to be mild, not too hot. So, yeah. It's just gone really hot today. You can see here in Bermuda, 21 degrees. You probably can't see that, but there you go. 21 degrees in Bermuda. Some rain going up towards the UK. But anyway, I digress with the weather today. I hope you are having a wonderful week and ready for the weekend. Please hit that thumbs up if you can. Of course, I ask you to do that every week, but if you can, hit the thumbs up, subscribe to the channel. Helps out a lot. And I have to apologize. I'm feeling so tired today, just dragging. I thought I didn't want to do the stream today, to be honest, because I was struggling to find interesting things to talk about. And what I do is I end up storing a bunch of emails from things that people email me. I just don't get time to go through. So I got a couple of interesting emails today. There's some peer-to-peer lending stuff that we will go through. And we cannot go through the stream without talking about what's going on in the financial markets. I don't know if you could use the word bloodbath today, but it's been a nasty day on the market. So we're going to talk about that. I mean, everybody's paying attention to what's going on here in the U.S., and it's obviously affecting stock markets around the world. Man with the what used to be orange hair doing some crazy things. So, yes, there you go. We still don't have a sponsor for the stream. I don't know if we will. We'll see. I don't know if we'll be able to continue doing the stream, to be honest. But, today we're here. Tonight we're here. Hopefully be back next week, but we'll see what happens. Yeah, I started this, I think, 6 years ago. Wow, it's been a long time. But I hope you get some value out of the chit chatter and stuff that we talk about, and that you found a good community. So I think that's important. Quick hello to everybody in the stream. We've got Peter Vince in Leatherhead who says it's another glorious spring evening there. AccuChep. Hello, Lawrence, Holly, and folks. Yes, Holly is still here, by the way. She is. I'll show you. I'll prove it to you. Hang on. Let me put the standing desk down. Oh, there she is. Right down there. Which way? I saw opposite. She's there. She's so confusing. She's there. I just thought it'd be fun to have a different camera view, something more interesting. I don't know why the camera's not working properly, but I'll try to get it fixed next week. Who else is here? Paul Bagworth in Kenilworth, Colin Perry in the Peak District, Al Stratford in Worcestershire, Mike Powell is here. That's just the tickers on the New York Stock Exchange as they drop rapidly. That's a good one, yeah. It's been a crap day. It's been a crap day for investors, but anyway, let's get into it. Let's get into some interesting things. By the way, if you haven't been to the Financial Thing website recently, go check it out. I've updated the stock of funds. It's the stock of funds. Told you I was tired. The index track of funds article I try to refresh every 6 months. Some other things on there, lots of articles. Some things need to be updated. I'll get to it when I have time. But I think this is a poignant article right now. This is about forgetting single stocks. We're seeing a lot of risk right now in the stock market. But if you haven't been to the website in a while, go check it out. Let's go to the news. We got Shojin adding a Barclays veteran to the board. Who is this person? His name is Graham Rusling or Rusling. Do you think it's Rustling or Rusling? He is a former Barclays executive and now an advisor to Shojin. For all you Shojin investors out there, he spent more than 40 years with Barclays Bank in various roles, including global head of restructuring. He is a credit risk specialist and spent the majority of his career in senior credit risk roles. More recently, Rustling has acted as a consultant, non-executive director, and chairman in a variety of organizations, including the executive chairman of the Institute for Turnaround, senior advisor to a distressed investment fund, and to Invest Tech Bank. He is also a trustee of the Queen Elizabeth Foundation for Disabled People. That's pretty cool. Sounds like a very, very, very experienced dude. In November of 2024, Shojin appointed Barclays debt structuring veteran Wayne Hiley as a board member. So I think that's good stuff. It's important to see who's advising companies these days, because all it takes is one misstep, looking at you, Elon, to shake down a company. Anyway, moving on. BlackRock launches a high-yield municipal interval fund. How exciting. I've been getting some questions recently. You know, I moved away from investing in bonds about 3 years ago when I saw that the interest rates were low. Bond funds weren't doing much. And I just saw equities as a faster-moving investment product. But now the tides are maybe turning, and now bonds may be something that one would want to start looking at. You can get 5.75% annualized rate on the initial net value asset, which is paid monthly. It's the BlackRock Municipal Credit Alpha Portfolio. This is after tax total return through income and appreciation of capital invests in municipal securities. So that would be bonds in the U.S., municipal bonds, local government bonds. Considered, I would say, a low-risk product. It takes advantage of inefficiencies in the high-yield market, and this is something that BlackRock has obviously got its paws into. Do I think it's something I would go for? No, probably not. I think for the risks that you're taking, you could just do treasury bonds. Just got, the big government bonds. But you start investing into all these different bond funds, and what tends to happen is, like, when you have too many mutual funds or tracker funds in your account, you start looking at which ones are doing well. And 1 year, one won't do as good as the other, and then you'll start moving your funds around, and that's when bad things happen. I speak from experience here. But it is an interesting bond fund. Municipal bonds are something that if you are wanting to get a little bit higher yield, and again, if bonds is something you want to look into now for fixed income, since stocks cannot be relied upon, even dividend-paying stocks now, which are getting hit hard by the stock market backward moving prices, you can take a look at bonds. Let's go to LendInvest, our non-peer-to-peer lending company that I like to keep an eye on. February 2025. Why is this February? This is a February newsletter. It's a little bit behind. I said in February they added 5 new investments to the self-select platform, one of which is a residential property in Bridgend, Wales. For all our Welsh friends. The borrower is currently carrying out light refurbished work and plans to market the property for sale. Doesn't seem like there's been that much on LendInvest. 5 investments for them is not a huge amount considering their multi-billion dollar assets under management. 5 investments, average investment amount only £115,000. Average return offered 8% per year. Average loan to value 53%. So pretty low LTVs. Geographical exposure. Look at those little small investments. Wales. We got the southeast, southwest, Yorkshire, and the Humber. Good old Yorkshire. That's my area of the world. And then Scotland for a total of £572,637. Now, if we go to the status quo of these live investments, we can see we've got 78 loans on schedule in the green, 11 loans, 10% in arrears. That means the borrower is not servicing the loan and has missed 2 or more interest payments. Then we get to the nastier ones, the out of term, 15 loans. There has been an unauthorized extension of the loan terms have been breached. And then enforcement, 4 loans. This is where legal action has started to recover the loans. So we're talking about 26 plus 4, 30 loans out of, 108 loans, either in arrears, out of terms, or enforcement. So that has not come down. To continue to monitor that situation because you definitely would like to see these numbers go more into the green, but they are what they are. LendInvest has had a pretty good track record of recoveries and getting these loans back on track. Here we go. There was a House Martin update. They've had a busy March and a productive month. They launched 2 new properties with a combined loan size of £1 million. That's crazy to think that House Martin wrote more loans than LendInvest. And House Martin is but a fraction of the size of LendInvest. Puts it into perspective. They've launched a property in Blackpool, a block of 2 6-bedroom flats, leased the Midlands Living CIC on a 20-year internal and repairing inflation-linked lease. And then 1 in Leeds, 2-bedroom bungalow leased to Let's for Life on a 5-year internal repairing inflation-linked lease. Good stuff. Those leases, by the way, are ones that cover where the person that's taking on the lease covers, or the company at least taking on the lease covers all of the internal issues or repairs for that property. So you can imagine 20 years. And I speak from experience as a landlord. One of the most costly things about owning a buy-to-let or a rental property is what can go wrong on the inside and on the outside too. So the fact that these leases are internal, repairing, plus inflation linked, because I do believe that inflation will be heading north and climbing soon. It was pretty good leases. See what else they got. They got another property in Leeds on Richardson Crescent that will be under consideration. And they did a site visit to the children's home on Brunswick Square in Penrith, which renovations are now complete. I do like what House Martin is doing. I think maybe, just maybe, instead of going to blend because of the cash drag, I might really look at House Martin as my next peer-to-peer lending dip toe into the water, because I'm starting to feel like these investments are doing good for the communities. And as I get older, yes, believe it or not, getting older, I start to look at ESGs and things that are doing good for the community, and I start to want to make a difference. I'm leaning towards wanting to make a difference with the places I put my money into. Although having said that, some of the shares that I own are probably not very ESG. But one can change, right? One can diversify into feel-good investments, and I think HouseMartin could be one of those. They've made some website improvements. Change of lease type to tenant type. We think the change is more informative. And then they have a grid view, which changed the lease style type display to occupant. The change now shows what supported living sector the occupants of the property fall into. So that's cool. Suspended markets. When a time-limited suspension is in place, this will now be displayed along with the time the suspension will be lifted. And then moving on, it has some updates on the existing properties. So if you are a HouseMartin investor, you can see those. For example, some of the good things here, Hazel Road, the annual CPI re-rating has taken place, so inflation linked, this being an inflation link. So the yield on that investment has gone up by 0.19%. That's what happens. When inflation goes up, these property yields go up. Let's talk about collateral. You know, for anybody that missed it, if you were a collateral investor like I was, unfortunately, one of my very early peer-to-peer naive investments that I didn't do enough background checking on the people running the company. And, you know, to be fair, I don't know that would have made any difference if I'd have looked at the people running the company, those two brothers. Would I have figured out back then that they were up to no good? Probably not. I just saw yield. I saw 12%. I saw the pound signs. The pound signs in the eyes. Get 12% for doing nothing. Sounds so easy. So I went ahead, sent them money from my Barclays account. Of course, years later we find out fraud has taken place. The company collateral was not under FCA authorization at all, even though they advertised to be. And the brothers went to jail. Not for enough time, I think, but they still were caught and went to jail, which is good. And then the FCA sent out a email years later saying that if you are a collateral investor and you lost money, you're entitled to a form of compensation. So I don't know if it's too late to apply for that compensation, but you can still try. I think you have until May, as my memory serves me correctly, to do so. You can Google it. It's all over the peer-to-peer independent forum, how to do that. Go to the FCA's website. But I went ahead and threw in an application thinking that I probably wouldn't get anything back, and this is what I got back. I got back an email saying on 17th of December 2024, the FCA issued an apology to investors in collateral who had submitted a complaint to the regulator between April 2018 and April 2021, which I did not. And then, 19th of December 2024, the FCA invited consumers who invested via the collateral platform who had not yet complained to come forward. They're offering a £500 plus compensation. It says, we are sorry you suffered financial loss and have a great deal of sympathy for your situation. Is that true? FCA, do you really have a great deal of sympathy for my situation? That's questionable. Losing any sum of money can be deeply upsetting. Causes significant worry and frustration. My complaint, I put it in. The complaint was part one, the FCA failed to manage accurate information on the Financial Services Register. Part two, the FCA failed to alert investors that the firm was not authorized or regulated after becoming aware of the misinformation on the register. Why did they not do that? It's a great question. So, the FCA has decided to pay me £500 because they have let me down. They've let me down. They've caused distress on top of the already much distress that turned this hair gray. Now, I feel badly for anybody that put a great deal of sum of money. I had about £2,000 in collateral, which, I mean, that's no small amount. But I also know people who have put in way more than that, 10, 20, 30,000 pounds. And they're getting £500 back plus maybe some more on top, but not much more. Is that fair compensation? I don't know. Probably not. I think probably the FCA should be returning more funds to people since they kind of let consumers down, but who knows if they would ever pay any more than that. But something is a little bit better than nothing. You cannot even write this investment off on your taxes, as I'm led to believe, because it was not an FCA regulated investment. So you can't apply for tax relief from losses on this because it is like a private investment. Correct me if I'm wrong about that, because I would like to write off this on my taxes, but I've been told no. But anyway, it's £500 is certainly better than nothing. And hopefully the Curry brothers are in jail, sleeping on a very hard bed, eating cold porridge, watching themselves in the shower, dropping the soap. What is more likely happening is these white-collar criminals are probably living it up in a relatively comfortable 3-meal-a-day environment, will come back out as convicted felons in the UK system, and they'll probably start another company. And hopefully they'll change their ways and they will not start another investment company, but we'll see what happens. Yeah. What else? LoanPad. Look, the rates are dropping as LoanPad did tell us was going to happen. We're now down to premium 6.2% on the 60-day access account and 5.2% on the classic. So dropped about 0.3% from the good times when we were at 5.5 and 6.5%. Now we are getting lower. If interest rates continue to drop, you can probably see that these rates will continue to drop. Also, I haven't logged in for a bit. Let's go ahead and log in and see what's going on. Give me a sec to do that. We'll look at the live data feed, which I really love. I think this is great. Who doesn't love data feeds? I mean, data feeds are great. By the way, you are coming up on, while that's loading up, let me show you. It's ISA time, everybody. You got a couple of days, that's it. You can use your allowance if you want to invest, whether it's in peer-to-peer lending, stocks and shares, or cash ISA. Get your money and you get £20,000 of tax-free goodiness. Any gains you make on those on that $20,000 for the year is completely tax-free. You must do it before, it says midnight on Saturday. I would imagine it would be 11:59 p.m. because midnight would technically be April 6th. So I'd get your money in before midnight on April the 5th. Take advantage of that ISA. See what we got going on here. Oh, there's the view. Still at 19 lenders, 196 million pounds of total loan value at loan to value of 44%. Nothing has really changed. Everything looks similar to the last time I looked. Total number of LoanPad loans since inception, 903. 634 loans were paid. I wonder if LoanPad has the most repaid loans of any peer-to-peer lending company out there that is still in business. That's a lot of loans, 634. So closing in on 1,000 loans. You can see estimated time to sell and to invest still less than 1 day. interest coverage fund not being used at the moment. It's a very small fund, but doesn't really need to be used because they just don't have that many issues with loans. Average lender is lending £18,628 per lender. So people seem to have trust and faith in what LoanPad is doing. Look at the total security value, £242.1 million. But yes, LoanPad does have an ISA available if you want to put in your allocation for this year, which I recommend you do if you can, if you have the money. Put in whatever you can. If you don't have 20,000, put in 1,000. Put in whatever 500. Put in whatever you can. Relendex is changing. I don't know much about Relendex, but they're having a logo refresh. They've been in business for 10 years of successful operation, so they're doing their logo, and they're doing a website refresh, which I think is a good thing. I thought I had a Relendex account, but I don't. But they do show the marketplace here without having to be logged in. You can see loan to value 40%. You can get a 7.5% interest rate on commercial redevelopment. That is senior A tranche state tree loan. So it's laid out nicely. It shows you the risk, if those risks are accurate. Coming soon, you can see here they got some coming soon opportunities ranging from everything 11% the C risk down to 7.5%. So if you're looking for places to put money, Relendex will have some available projects. You can see all the loans that they've completed. So a lot. There you go. I wonder what that logo is going to look like. I wonder if they'll still keep the lion. Cufflink is also telling you 3 days left. You got 72 hours. Is that right? It's less than that now. You can get a spring rate boost. You want to do the 2 year, you can get a rate boost. I think, right? Is it? Those are the rates right now. 1 year. Annual rate 9%, 2 year 9.78%, 3 year 7.87%. And I think you get a rate boost on the 2 year, maybe. It says gross annual interest equivalent rate 10.26%. And for right now, you can put in a £500 for your first investment instead of the usual 1,000. So if you want to give a Cufflink a try. Oh, and also I thought this was interesting. They got a WhatsApp chat number now, so if you want to get a hold of them, you can use the WhatsApp. That's the phone number right there. Send them a message if you have questions. That's cool. I think every company should do that. People want fast answers nowadays. That's how you get it. Vanguard. Let's see. Vanguard always sends out interesting emails when stock markets start to get funky. Right now they are getting funky. They say U.S. tariffs, stay focused on your long-term goals, people. This is Vanguard UK. It says the U.S. tariff announcement on April 2nd may lead to increased stock market turbulence in the upcoming days. It's natural to feel unsettled when markets are choppy, but we would caution against making short-term changes to well-considered investment plans. You have 2 days left to maximize your ISA allowances, which will get you closer to achieving your goals. And if you're concerned, you can consider parking any remaining allowance in a low-risk money market fund and move the money into shares when you feel more confident. They have a blog on their website, which is, I think it's a great blog, because what happens is, when these stock markets start to get really choppy, which is happening right now, people get scared and then they start to sell things, buy things, and try to market time. And that's always a foolish experiment. It's very hard to time markets. It says the U.S. announced a levy of 10% on nearly all U.S. imports from April 5th, as well as adding additional tariffs on some trading partners. All other factors being equal, higher tariffs and other barriers to trade are likely to slow economic activity and lift inflation, at least in the short term. In the medium to longer term, however, the latter period being the most important one, so longer term, trading partners are likely to adjust their policies. Affected countries are likely to negotiate with one another, and further policy adjustments may follow. Companies and consumers may reconsider their saving, spending, and investment plans. Central banks may consider their interest rate policies to support economic growth and keep inflation stable. For investors, uncertainty is likely to remain. Says they caution investors against short-term portfolio changes. Given the potential tariff countermeasures from trading partners, it's difficult to identify specific investment implications immediately following the announcement. Financial markets may respond quickly to developments as they unfold, but we would caution long-term investors against reacting with short-term changes. Very, very good advice. Just stick to your plan. Follow the road. Vanguard knows what it's talking about, but it is hard. It is hard to do that. You pull up a finance news website today, and this is what you're going to see. Trump's tariffs wreak havoc, puts the Fed in a bind, automakers struggle. It's just all negative. Downgrades on companies. You even go to the BBC. You go to the BBC's website. What do you see? You see negative news. Look at this. The first thing you see, U.S. stock market plunges. I think at times like this, you're almost best just to stay off websites because these news companies are biased anyways, and they go off fear. There's no good news on any of these websites because they don't want you to feel good. It's just all bad news, right? Look at that guy. He doesn't look happy. He doesn't look happy at all. But what is going on out there? Well, I'll show you what's happening in the Trading 212 portfolio. 24,317. I was scared to look at this today. I thought this number was going to be worse. We are all kinds of red. We got more reds than the Republican Party. MicroStrategy, 17% down. Our trusty S&P 500 fund, 8% in the red. NVIDIA, look at this. Almost right back to where we started. 4%. 4.7% in the green. Tesla, down 20%. Amazon having a horrible day today. 8% in the red. Gross. When you see numbers like that, you start to really get worried. And the most difficult time to invest is when stuff like this is happening. And somebody asked me, do I think the old school strategy of buying the dips is over? And that's a good question. There is a lot of economic uncertainty out there. People, tend to run towards things like gold, bonds. They may even start to run to places like P2P lending for that fixed income when the stock market is so volatile. I got a question about this. This is very pertinent. Good timing. Stock market fears. Hi, Lawrence. I started investing about 7 years ago after being somewhat inspired by your writings. Well, glad to be of inspiration. It's funny when people say thank you. It makes me kind of blush because I'm actually quite shy. But I do appreciate when people do write nice things like that. It's very kind. And it really does warm my heart that I can have some good effects on people out there, because I started this website as kind of a project back in the day, the Financial Thing website, but it does help, especially in times when you're not feeling good about what you're doing with your investments. Anyway, back to the email. I could definitely relate to being older and starting my retirement investing later in life, which parallels your story. Yes, it does. I started in my early 40s. Didn't really have anything invested prior to that. I'm now 52 years young. About 3 months ago, I became paralyzed by fear and stopped investing. No, he didn't just stop it, he stropped. He stropped investing. He got stroppy, stopped investing. My thinking was that I would just wait till the markets dropped and then invest a lump sum into my pension pot in the future when things look more stable. Ha! Right? Good idea in theory. This guy's name is Roger. Roger says the problem now is I find myself stuck in a holding pattern and very fearful of investing money into these markets, especially now that Mr. Trump has caused such negative sentiment with his tariffs and other actions. My logical brain thinks I'm going to lose all of my money in the stock market. What is your advice for someone like myself? Should I keep investing now? Forget all of this negative news, or is it best to sit out and continue to wait for things to settle down? Thanks for any advice you can give me. Sincerely, Roger. This is such a common fear. I have these fears too. I mean, today would be the perfect day to say, you know what, I've got a couple of £1,000 in cash in this account. Today's a good day to invest, but a day when the S&P 500 is now 4.77% in this Vanguard fund down in one day, I start to get nervous, just like everybody out there, and asking questions like, what is the best time to invest? Am I supposed to sit out? Am I supposed to invest? You pick up the crystal ball. It doesn't tell you anything because the honest answer is nobody knows. I don't know. I have no idea. I could just speak from past experience that things tend to go up over the long run. If we look at the 1 week chart in the S&P 500, the Vanguard fund here, it doesn't look great. The 1 month doesn't look great, and the 3 month is not looking great. But then we start to max it out, and it looks fine. And there's a great saying, when in doubt, zoom out. But this could be a good time to start looking at some fixed income products. I don't know how old Roger is, because that's an important thing. I'm presuming he's in his 40s. He says he started about 7 years ago, in his 40s. So I'm presuming in your 40s you still have time for property, for stock markets to crash and recover. When markets do crash, the recoveries that tend to happen the fastest are right after crashes within the next year or two. So, but I think diversification is key. It's times like this when you get market corrections of, 1 day corrections of 4% over the entire market. You can see here FTSE was down 1.55% today. I think they're going to have another bad day tomorrow. Within the U.S., minus 4% on the S&P 500. NASDAQ down 5%. In 1 day, this is a big drop. And this is a time where you evaluate, how much risk are you really willing to take when it comes to your investments. It's the same for peer-to-peer lending. You start to look at how much do you have allocated in one peer-to-peer lending company. And when things are going bad, that's when people start to look at, maybe I'm a little bit too invested in 100% equities, or maybe I have too much money in cryptocurrencies. Maybe I got too much in peer-to-peer lending. It's a good time, as they say, to evaluate your jitters. And if you're older, there are people that think having a good percentage of your money in fixed income to offset some of these down days where you may have a crazy leader of a country doing crazy things who may or may not know what he's doing. Not to get political, but I'm starting to think maybe he doesn't know. Who knows? When you have these drops of 4% in a day, this is a good day to reevaluate how much risk you're really willing to take. So back to Roger's question. Look, the only way I've ever known not to have fear is just to not look. When things are going bad, not look at the accounts. Don't log in. Just keep investing. I don't think stopping investing is the answer. I think most people would be best just to continue investing throughout the entire period of their investment lifetime and go through the drops and go through the peaks and go through the valleys and don't think too much about it. But Roger, you hit a very common problem here. You stop investing or you pull your money out. Now you don't know when the best time to go back in is. And you may sit out for years. And you may miss some real opportunities. So I think I wouldn't I wouldn't sit out. I would just keep investing and just diversify. Have some bonds. Have some peer-to-peer lending. Have some stocks, some tracker funds. Just keep Stay the course. That's the most important thing to do. Another email. Buy to lets. Hi Lawrence, will you be releasing any more Trading 212 videos? I missed those. Yes. Ugh, they take so much time to do, but I will hopefully get one done soon. I'm 37 years old, living in Hampshire. I've been thinking about buying a buy-to-let for my first investment. What do you think about the prices at the moment? Is it a worthwhile investment? I would have to use some financing to pay for it, but I do have some cash saved up too. I would appreciate any input. Ollie, 37, very, very young. Good. Well, buy-to-lets are a funny thing. They say that you make money in property when you buy, not when you sell. So if you can buy something that is distressed, or you're a handy person and you can renovate yourself, sure, there are some opportunities out there. But with interest rates high, rental properties are difficult. If you're paying 4% on a loan, it's hard to make money unless you're in very, very high-yielding places, maybe like the north of England, maybe Northern Ireland. I don't know. I'm not familiar with those. Prices are what they are. Again, timing is difficult when it comes to properties, but check out the auctions. There are sometimes you pick up deals there. But what I can show is a rental property that I did own a percentage of, and I can show you the numbers on this property that I owned from 2019 until 5 years. Basically 5 years. Here's the numbers. I'm going to show you the numbers so you can see a real example of what you could expect. This is the little property that I had a ownership in. This is a 2-bedroom, 1-bath, about 67 square meters down in Dorset. Here's the numbers. It cost $222,000 to buy. This was a rental property, so had to pay stamp duty. And then over the 5 years, we had $20,000 in repairs. We have $5,000 in vacancies. That was the months that it was not rented, so lost income. $5,000 in management fees, and we got $55,000 in rental income, and sold it for $265,000. So it was about an uptick of asset increase. So the price of the house went up about £43,000, so that was good. But the ROI, here's the real numbers of the ROI, and this is before tax. 25.98% for 5 years. That's about 5.16% per year, and that was before tax. And there was some headaches there. Now, obviously, if you did your own management, maybe you do your own repairs, you're going to save money. But we had all kinds of repairs. We had leaks. We had gutter issues. A squirrel ate up all the gutters and then started eating something to do with the roof. Those little top things that you have up there that stick out of the roof. I think the squirrels were chewing on those lead pipes. We had to seal the conservatory that was leaking, paint, bathroom leaks, blah, blah, blah. So these are the things you just don't know that you're going to face or not. Some people go through without any repairs. I've never heard of anybody with a buy-to-let that went through ownership without having some kind of repairs, and sometimes it can be significant. And sometimes you don't want to claim on insurance because it's just not worth it. They put your insurance fees up, and you've got your excess to pay. So we just didn't claim on the insurance because it was never really big repairs. It would be a new, a leak that was 700 pounds, and then a new boiler, 3,000. It just really all adds up. So 5.16%. Now, there is also a number here on the end, stamp duty on sale. Most people are not going to face this, but unfortunately, because we owned this property jointly, when I sold my share of the property to the other owners, they had to rebuy the property. And I don't know if there was a better legal way to do it. I asked about this, and the lawyer said there wasn't. If somebody else wants to buy the property, the problem was it was in a limited company, and so when I gave up ownership, it went into their personal names. They could have left it in the limited company, but that creates future problems because they don't want to own it together for a long period of time. They got to get it out of the limited company into personal names, and stamp duty gets incurred. And unfortunately, stamp duty had gone up. So we ended up paying another £14,000 on sale in stamp duties. That brought the ROA down to 19.4% before tax, so 3.8% per year. Now, obviously, there's better areas you can buy high yielding rentals, but for the amount of outlay money, for the amount of money to come back at 3.8%, even 5.16%, you're better off at the time sticking the money into a savings account and getting 4.5%. You don't deal with the headaches. You don't have the rental headaches, the management companies, the repairs, getting new tenants when somebody leaves and you've got 2 months of vacancies. And then you have to pay the management company a set fee when they have to go out and find a new tenant for your rental property. They take a portion of the first month's rent too, so that goes into those management fees, and it gets expensive. So I wanted to get out of this because I thought 4.5% per year I could just do better with the money in other places. I could put it in peer-to-peer and get 6.5% without the headaches, right? I could stick it in LoanPad or Easy Money and get 4.5%, 5%, 6%. And I don't have the risk of a tenant, taking a pee on the carpet or smashing in the front door or God knows what else. And I just decided it wasn't worth it. So you have to look at your own individual situation. Now, if I was financing this on a loan, there's no way to make money if you're making even 5.1% a year. And obviously Dorset is an expensive place to buy and the rents are not particularly high. So it doesn't match up financially. But if you're adding a loan into that, loan costs, and taking off 4% a year in loan costs, you're just not making any money. And this, with the stamp duty, you're actually losing money on that rental property. So personally, for me, it wasn't worth it. Maybe it was just the investment was wrong. We paid market price for a property. We just needed some place to store some money for the time being, and at the time nobody wanted to go out and try to find a deal, so we just went on market, and we had to do some renovations to the place to get it into rentable order. But I just decided no, it was not for me. So you have to do your own calculations, and it's not difficult to figure out. I mean, if you look at that spreadsheet, Ollie, thanks for your question, by the way. You can pretty much take 10% of your purchase price over the years and figure in 10% for return for the repairs every year. So take off the repairs, take off a vacancy amount, take off the management fee if you're doing it yourself, and you can get some pretty accurate numbers about how much money you're actually really going to make on a buy-to-let. And a lot of people, they fool themselves into thinking that they're making really good money on rentals when they're not, especially after tax. Now, I know you can get some tax advantages if you have it in a limited company. Like some of these expenses can be written off, but a lot of people just really fooling themselves as to how much they're actually making on rental properties. Now, if you were able to buy a rental property 25 years ago, yes, of course, your quid's in. But now properties are expensive. Our rents have not been going up a ton because people are struggling, especially in these lower tier types of houses. This house now is probably, I think the rent started out at $850 and $900. Now it may be at £1,100 a month, so it's gone up a touch. But yeah, after you take out taxes that you have to pay on these returns, the returns are not great. So you got to really go out there and search for a good deal. Try to get something like this for 10% less from retail. Maybe then you start to look at it and go, well, yeah, maybe it's a good deal. But if you are involving financing, it's tough to make money in this market in buy-to-lets. But that's just my personal experience with it. Maybe that wasn't a good example, but it is what it is. Let's look at, and thank you for the question, by the way. Let's take a quick look at the old Mr. Bitcoin price. Not doing too bad. considering I thought it was going to be much worse. 81,958 US dollars right now. 7%, well, down 6% in the last week. So, yeah, I mean, it's okay. It's better. I expected this number to be down into the 70s, 75, 76,000 with the day that the stock market has had, 24 hours. You know, we're talking about 4.9% down in 24 hours, which is pretty much what the stock market has been, give or take. But it's an interesting time right now. People are in fear of Bitcoin. And crypto in general, 25 is now the extreme fear time. And I've always gone by the sentiment that when people are in extreme fear, it's a good time to buy certain assets. Do your own research, of course. Hey ho, that is what I got for you today. Hope you enjoyed the stream. I'll have a quick look through your comments. Please hit the thumbs up if you have not already done so. It really does help out the channel. It may also be a good time to get into international stocks right now with the uncertainty that Mr. T is giving to the US. Who knows? I don't know. I don't know much more than anything. I just think things are really unstable right now. Alan Stratford says Somo has redeemed more loans than LoanPad. There you go. I thought 600 and something loans was a lot. Richard says House Martin, since it's a social lender, it would be great if a mutual building society would invest a few million into it, supporting the funding of supported accommodations. I agree. I think they're doing good things. I like it. Alan, I put lump sums into global trackers today. At least they're about 12% off their peaks. No idea what tomorrow will bring. Yeah, I think, I mean, in 4 years' time, hopefully Mr. T doesn't figure out a way to serve a third term and this will all be forgotten about. Everything will be fine. People panic in the short term, so I don't think that's a bad idea. And Alan also says my experience with rental property was a 4.3% return for 20 years after all costs. Not worth the considerable hassle despite having a management agent. Yeah, I think this is that's a very honest accounting of an experience there, which I think a lot more people have than they would care to admit, because everybody says, oh, UK property, it's so great, so stable, can make money. 4.3, it's not great, but it is what it is. You take a risk and sometimes it works out, sometimes it doesn't. Anyway, hope you enjoyed the stream. I'm going to get out of here. We've been going for almost an hour. Thank you so much for joining. We'll take a little look at the very jolty and jittery camera. We have blue skies. I hope the English weather is treating you well. We'll see you next week, all being well. And that's all I got this week. So thanks for joining. Much love to everybody. Bye-bye.